So it is after midnight, Sunday night, early Monday morning, a day after Saudi Arabia announced that they were going to cut their oil prices significantly and increase production. And let's look at the effect it's having on the market tonight. So here we have crude oil futures, and they are down 32%. In addition to the 10% that they were down on Friday when Russia refused to cut production. So now here the Saudis are going scorched earth and increasing production even after they tried to get the Russians to decrease production. So, and look at the effect it's having on the stock market in general. S&P futures are down almost 5%. Dow futures are down about 1,200 points, also about 4.7% down. So I guess the question most people are wondering is this a buying opportunity? Should I buy the dip? Should I dollar cost average in like my financial advisor says? Well, that's kind of what this video is about. It's about why you shouldn't always listen to the common wisdom that always tells you just buy forever and any dip you should be buying and you'll make it up in the end. Let's take a look at the oil futures chart. Well, if you like buying dips, take a look at this chart. It was what, above $62 or $64. Now it's 31 since January 8th. So in exactly 2 months, it dropped 50%. Okay. Let's look at S&P futures. On February 20th, they were almost 3,400. They dropped as low as 2,850, about 500 points or 15% or so within 1 month. That's a very fast move down. So the easy answer is, if you've only been investing or trading or just in the stock market in general for less than 10 years, you should really rethink the advice you've been given that the stock market only goes up and any dip is an opportunity to buy more, because it doesn't always work out that way. And when it does turn around in the wrong direction, that's when people usually get crushed. And that's the reason why most investors' returns are way lower than the actual market returns. So let's take a look at the S&P SPY ETF, which is the S&P 500 ETF, going back, 25 years or so. Okay, let's see, this is the internet bubble here back in March of 2000 at around 155 or 1500 on the S&P, let's say around there. So anyway, if you were just buying and buying and buying forever, you lost from the peak about 50%. This line here is 75, this is 157. So a little more than 50% from the peak here to the bottom here. Okay, and it didn't reach a new peak, which is about the same until 2007, which it never went above that. And then it fell again back another 50% from that peak and didn't recover until here in 2013. So for the people that say dollar cost average, or you can't time the market, or time in the market matters the most and all that kind of stuff, if you were unlucky enough to be one of the people that were buying the euphoria here in the internet bubble, okay, the .com craze, your money was dead for basically 13 years. I mean, that doesn't include whatever dividends the S&P was paying, maybe 2% or something like that. But for 13 years, do you really think most people had the wherewithal to keep buying even all the way down when they're down 50%? Usually the way it works is like this. From the last bottom, everybody is sick of stocks because all it does is lose and they don't want nothing to do with it. And the market goes up, and right around here, they start noticing that all their friends are making money and all this kind of stuff, and it's in the news. So they start buying around here. The market tops and it starts going down, and some of them keep buying because they think it's cheaper and cheaper and cheaper until it goes down so much that they can't stand it anymore, and they capitulate here and sell it all out. And then again, they don't want nothing to do with it, with any stocks, until maybe it's around here, and then they start getting back in and getting the euphoria, and once again it starts going down. They start dollar cost averaging down or averaging down because they think it's a little cheaper, and eventually the pain just becomes too much and they sell out somewhere around here, and the cycle repeats itself. Now, from this bottom in 2009, we've just had basically a straight up rocket ship for 10, 11 years now. So for anybody that thinks that the markets only go up, take a look at these long 13-year period of basically stagnation. And so yeah, the market did break out and it's up, and it's still very close to its highs. So if you are thinking that, hey, the market's down 15%, all I have to do is close my eyes and buy and turn off my computer, in a few months, I'm going to be looking at new highs again. That doesn't always work. I mean, it works until it doesn't. And now we have a new monkey wrench in the equation, which is the whole coronavirus, which is killing all kinds of demand in all kinds of economies, in travel, in manufacturing, in everything really. So it's kind of a moving target, and it's changing very quickly, and so it's not definite that this is going to turn out well very quickly. Like, it's no guarantee that this is going to turn around or it's just going to burn out in the spring or something like that. It may, but the implications of the supply chains and all of that being broken are going to have real effects on companies' earnings for the foreseeable future, a few quarters at least. So nobody knows where this is going to reset to make up for these. And just to show you how investors usually, not how they think, but how they actually act, here's a chart of the difference between the share of household equities and mutual funds owned by the top 1% versus the same owned by the bottom 90%. And this is just what I said in terms of how most people think that on the way up to the top is when people have euphoria and they start buying on the way down, and then they capitulate and they are flat at the bottom, and they don't get back into stocks until the thing is going back up and has everybody's interest again. So this is how the 1% invest. These gray marks are recessions, and you see, as this is the S&P and this is their investment percentage amount. As the market's going up, they're getting longer and longer, right? But before the recession hits, they are selling their stocks until the recession hits, and then the market bottoms out, and as the market's going up, they're getting really long really quickly here. And again, the market peaks and their stock allocation peaks and they sell out very quickly and do it all again when the market bottoms and it starts skyrocketing. Their allocations go up a lot. Now look at how the other 90%, the bottom 90% trade. Okay, as the market is at a bottom, they're at their highest allocation, and as the market goes up, they are getting rid of everything. Okay, so here they are getting long, right? They're buying more as the market is tanking. And when the market bottoms right here is when they have their peak allocation and they are selling frantically, steadily as the market's going up. So again, they're at their highest allocation when the market is at their lowest. And when the market's falling, they're buying. And then they give up and the market turns and it starts going up and they start selling out. So the market is just going up and their allocation keeps going down and down and down. And so that's why the difference in returns of what the market returns versus what most investors actually realize in their investment are two different things. And you could see that here. Investor returns for equity funds versus the S&P 500. S&P 500 1 year 12%, investors get about 7. 3 year is about 9%, investors get 3. Okay, even the 30 year is 10% return on the S&P. Investors return is more like 4%. Why is that? Just because what I said, it's ingrained in people to want to sell when things are looking bad and want to buy when things are looking good, which is kind of the opposite of what you're supposed to do. This is the Shiller's 10-year forward annual return from PE levels. And what that means is every dot represents a 10-year return, okay, from every month that the stock since like 1871 or something like that. So if you look at this return, you can see that when PEs are low, returns, 10-year returns are high. So look here at this 5 PE, the returns, most of the returns are above 10% for the next 10 years, on a 10% per year for the next 10 years on average, as high as 20%. As the PE gets higher, the 10-year returns going forward are lower and lower. And right now the S&P is in the mid 20s, something like that, 23, 24, was as high as 26 recently. And so that would mean an area like here or here really. And so you see that there are a lot of returns above 20 to 25 PE. A lot of these returns are actually negative for the next 10-year period. A good amount are positive, but not that high, 6-7% positive, and as low as 3-4% negative for a 10-year return. So basically what it's saying is that the higher the return, the higher the price of the market is, meaning the higher it's gone up and the PE is very high and everybody's euphoric, the lower the average return for the next 10 years is going to be. And so again, it's kind of the opposite of buying low and selling high. A lot of people want to buy high and sell low, and this is what happens when you're buying at these high levels. Your forward return for the next 10 years or whatever is going to be a lot lower. And let's take a look at the S&P 500 PE ratio going back to 1870 or so. Right now we're at around 22, let's say, on the PE ratio for the S&P 500. Here's the internet bubble where the S&P went up to, what is that, like 43, and here is the financial crisis when it went up to 65. Okay, so if you look at this chart, you could see that the average PE of the S&P 500 should be somewhere around 15 or so. When it starts getting out of whack like that, the last thing you should be doing is trying to buy the dips that are just a few percentage points away from the high, the all-time highs, especially on a 10-year bull market. So this was my look at what's going on tonight in the stock market and the oil market. I hope you like this and you got a better perspective on the valuation in the stock market right now. And if you like this video, give me a thumbs up, leave me a comment, let me know if you think the market is cheap or expensive right here, even with this 1,200 point drop in the Dow. And if you haven't done so, please subscribe. Thank you for watching.